Our next guest is out with a new note today saying that the markets could kick off 2024 with a short-term pullback. Let's bring in NewEdge Wealth's Ben Emons, a guy who casts an eye on macro all the time. Ben, you heard the conversation on the desk. I wonder what you think about that overall big picture for the global economy. Is it supportive, and why do you think we're due for a pullback?
Yeah, I would be with more the others about this pullback. You know, there's several signs, I think, Dom, for the short term. You know, if you look at the RSI indicator, you know, the S&P, the Nasdaq, and the Russell are all overbought on that indicator, but they mostly are overbought as much as they were overbought during the 2020-21, you know, let's say bubble moment, and they even is overbought for a longer period of time. You know, I think it's almost like a month and a half now, so that's quite stretched. And if you then take the story to interest rates that we're just discussing, you know, the market, the bond market, in my calculations, probably priced more like 75 basis points of excess rate cuts. It almost looks like the bond market is priced for this perfect scenario of a second Fed pivot to faster, deeper cuts. I think that's the tension as we're getting into the new year. You know, we have a packed agenda of big data. The economy shows some sign of acceleration. And GDP now went from 1.25% to 2.25% over the last sort of 4 weeks. So there's some sort of acceleration going on. So I think interest rates are primed to pick up a little bit from here and then take back that overbought condition on the equity indices.
What part of the market is going to be the most vulnerable to that pullback? Is it going to be the stocks led to the upside? And if that's the case, then which stocks do you put on the list in case it's just a dip to buy?
So I found notable, Dom, that, you know, if you look at small caps, right, and you plot that against the junk market, you know, take the J&K ETF against the Russell 2000 ETF, since the end of October, it's just exactly straight line up, more like a lockstep. So as Julie says too, and Steve says, like these sectors are highly interest rate sensitive. I would almost call them like they're sensitive to the relief of interest rates. So if you get a bit of a backup in rates, I would think that there's where you see the first real correction. Seems like kind of a bit of a frothy moment there in each market. On the other hand, you know, the big cap, the mega cap are probably going to stay in a good trend here because that's really about earnings. And I don't see these earnings being downgraded so quickly just because we're getting a short-term correction in rates.
So, Ben, when you look at overbought, obviously overbought, a stock can be overbought, the market can be overbought, and it could work that off. But as far as that second pivot, I think the second pivot's going to come from inflation falling a lot quicker. Have you calculated that? Do you think that could fall in a precipitous fashion and leave Powell sort of trying to catch up?
Yeah, I think it's a good point, Steve, in the sense that if you look at the PCE deflator that came out the other day, you know, in that basket, there's deflation now. And, you know, there's about, what I calculate, about 10-15% of the index is in a deflation for the last sort of 6 months. A lot of these categories are influenced by supply. So it's maybe to an extent not so surprising, but it's telling. So say that deflation starts spreading further in the core PC deflator, then you get the scenario we saw back in 2022. The Fed is, again, behind the curve, ironically, having to come forward with more rate cuts faster. But I think at this moment where we are right now, you know, we're not yet in that really, you know, like accelerated down move in inflation yet. So I think it probably is going to be something more of the second half of these rate cuts starting. Again, idea that the economy stays on its feet and inflation just continues to moderate, giving the Fed room for some rate cuts.
So, Ben, in terms of gold, obviously something I know you like quite a bit. Here we are 2 years later from the peak in the S&P. S&P is basically unchanged, and yet gold's up some 14%, one of the best assets over that 2-year period. Obviously, you're sanguine on gold. You think gold's going higher this year. If you had to pick gold versus the S&P for the next 12 months, which do you prefer?
Well, gold is interesting, Carter, because, you know, it is this asset that can outperform in an environment where there's uncertainty, but it can also outperform in an environment where you have easing conditions. And that's actually what's happening currently. Right? The last sort of month, as we talked about the previous show, you know, gold has had a reasonable performance here in December. It actually broke out to a record high when we talked about it. I think this has more scope. I mean, if 2024 is a year where a lot of people do expect a fair bit of uncertainty, it probably will fuel gold. On the other hand, it's this rate cut story, as we talked with Steve about, like, yeah, if you get accelerated rate cuts, then gold will really go a lot higher. So to me, gold is a really interesting asset for 2024 as a diversification portfolio. I think it could add in that sense value.